Okay, guys, let's start the question. It's a risk management question. Let me read the requirement first. Then, obviously, we will discuss the scenario. I didn't solve it earlier, so I don't know whether it's a difficult question or easy. But let's do it. Advice on hedging strategies based on the hedging choices that the finance department is considering. Okay. The loan of $24 million, assuming the central bank base rate rises to 5.9%. So that is one part. Investment of $18 million, assuming the central bank base rate falls to 4.5%. Okay. Score your answer with the appropriate calculation and discussion. 13 marks. Discuss the queries raised by each of the directors. So in part A, 4 marks were available for the discussion. Okay. Professional marks will be awarded for the demonstration of skill in analysis and evaluation. This analysis and evaluation means you have to discuss the numeric which you have performed above, skepticism, and commercial acumen in your answer. Okay. Let's read the question. Okay. Aber is planning a change in its arrangement for distributing its products. The company wishes to dispose of its large distribution center in the middle of its home country and invest the proceed of sale in two smaller distribution centers, one in north and the other in the south of the country. So you are planning to dispose of its large distribution center and you will invest the proceed in smaller distribution center. Okay, in 2 months time. In 2 months time. Okay, nothing is mentioned with the 2 months. It is currently 1st Feb. Because of the expected timing difference in the 3 transaction, Aber company expects to take out a short-term loan of 24 million on 1st May. Today is 1st February, Feb, March, April. After 3 months, you will borrow on 1st May to 1st September, May, June, July, August for 4 months. It can then expect to make a short-term investment of 18 million from 1st September. So after 7 months, you are going to do the investment for September, October, November, December, January for 5 months. Okay, today is 1st February. This is important, the second paragraph. And you will take a loan on 1st May, Feb, March, April. You will borrow after 3 months. You will borrow on 1st May till 1st September. May, June, July, August for 4 months. After 3 months for 4 months. Total 7 months. Then after 7 months, you will invest 18 million on 1st September for how many months? For 5 months. September, October, November, December, and January for 5 months. So Aber company intends to hedge interest rate risk using derivatives. The terms offered on derivatives are based on the central bank base rate. It can be assumed that future or option contracts are settled at the end of each month. Basis can be assumed to diminish to 0 at contract maturity. Based on the monthly time interval, it can be assumed that there is no basis risk and there are no margin requirements. 24 million loan. Company can borrow at central bank base rate plus 40 basis point. At present, the central bank base rate is 5.1. Commentators expect the government to raise the central bank base rate by up to 0.8% to 5.9 before 1st May. Aber company finance department intends to use forwarded agreement or hedge or future to hedge the loan. It has already found that using a forwarded agreement for the loan would result in a net payment of 461,600, which is an effective annual rate of 5.77. So technically, he has given you the answer of forward. 3-month future is given. Okay, then 18 million investment. Aber company invested a central bank base rate minus 30 basis point. An election is due on 1st July. The main opposition party has promised that it will reduce the central bank base rate from whatever the level was before the election. Commentators expect that central bank base rate could be minimum of 4.5% if the main opposition party wins the election. At present, the election result cannot be predicted with confidence. It can be assumed that interest rate will not be reduced if the current government wins the election. So there is uncertainty. Aber company, so in uncertainty, in volatile situation, which would be the best solution option? Aber company finance department has already found out that using a forwarded agreement, the investment would generate 378,750 income, which is 5.05. Because of the uncertainty surrounding the election result, finance department is looking at buying the call option as an alternative to using a forwarded agreement to hedge the investment. So call option is given. Okay. So let's read the director's comments. At the last board meeting, Aber company finance director explained to the board the possible strategies for hedging the loan and investment. She has received a number of queries from the directors. Director A stated that Aber company should not be using derivatives, as trading in derivatives was not part of the company normal activities. Therefore, shareholders would not expect the company to be using derivatives. Okay. Director B understood the future or forward rate agreement might be the best solution. The central bank base rate rose up to 5.9 or fell down to 4.5. However, she queried what would happen if rates did not rise as high as 5.9 or not fall as low as 4.5. Eber company could possibly lose a chance of benefiting from more favorable rates than those offered by the future and forward. Okay, it's a genuine concern. Director C stated that option should not be used to hedge the $18 million investment, as they would never be best choice because of their premium. The best choice would be not to hedge at all. Okay, so we will do this in the B part. Let's quickly do the A part. So do you have any question till now? Any question? No? Okay. Let's solve the loan part first. Part A. Loan. $1,000,000 24. Okay. We have a two derivative forward. And in forward, it was certain that payment would be how much?
461 something.
461,600, effective rate 5.77.
Yes.
Effective, let me write it.
Effective 5.77, yeah.
Effective payment in dollars, 461,600. Okay, instead of putting dollar everywhere, you can write in a single line that all figures are in dollars. Figures are in USD unless stated otherwise. Okay, and write this in 24 million and raise this million sign. Okay. Okay, effective payment is given. Effective rate is given.
Yes, 5.77.
That is in percentage. 5.77.
77.
Sorry. 5.77%. Okay, now let's do the future contract. Future contract. Okay, first step, we already know that loan amount 24 million.
Yes.
Okay. Second step, obviously, if we are borrowing, that means we have to pay the interest. So that's a sell future.
We are buying bond, yeah. We're selling bond. Sell future. Sell future.
Sell future, and the rate would be which contract? Sell future. We are borrowing on 1st May, the June contract.
June contract, yeah.
June contract at 94.55. Okay, guys, you can move in in this inverse form, or you can also move in a interest rate form. So I will solve in both ways so that you get the idea. So this is 5.45. 5.45. Okay. Then future rate is sell future June contract. Number of contracts. Number of contracts. Okay. What is the amount? 24 million.
24 million.
What is the contract size? 500,000.
One, I thought, yeah, sure.
What is the duration of loan? 4 months. What is the duration of
Over
future? 3 months. The
3
number of
months.
contracts are 64.
64. Correct.
Number of contracts are 64. Okay. Now we will calculate the closing future. So as closing spot is expected, how much closing spot is? 5.59. 5.59. Okay. 5.59. Okay. Closing spot. Current spot is 5.51. 5.51%.
It's 5.9. It's 5.59.
Current is 5.1 and the closing spot is 5.5. 5.9.
5.9.
Sorry. 5.9.
Yeah.
Yes. 5.9. Okay. Now,
Correct.
today is 1st Feb and you are going to borrow on 1st May. And you have chosen the June contract. So number of months in maturity, in future maturity.
For the current for it's 5.1. 5.1.
Today is 1st Feb. Today is 1st Feb. Future maturity is 30th September. Take the difference. How many months are there? But I think you can save the time and you can do this by your own. Like you can count this on fingers. That is not that difficult.
Go on. For 7 months.
Okay. How many months in maturity? Months in maturity. So count. So this is, June contract. 30th June. This is 30th June.
It's 5.5 months.
Okay, how many months? Feb?
5
months.
months.
5 months.
Sure.
And remaining months? We are borrowing on 1st May, so remaining months are 2.
2 months, yeah.
Let's calculate the closing future. Formula is closing spot plus bracket start opening future minus current spot into remaining months divided by total months. So that is 6.04. Please check.
Yeah, it's correct. But I like doing the whole formula. Closing spot.
This is
These things you can easily
6.04.
forget.
Please check, everyone. Okay. Okay. You can also do in inverse form. Let me tell you as that as well. Okay. Today you have chosen 94.55. Closing spot is 5.9. 5.9 in terms of inverse number, this would be 94.1. This is 94.1. You can remove the percentage. 94.1. Okay. Mashallah. System is so beautiful, so elegant, just like a wow. So it's not expecting the accepting the number. Let me convert it to general. Percentage sign is permanent. So guys, this is not a percentage, but system is not accepting. So I'm writing in this way. 94.10. Okay. And you can calculate directly in this. Closing spot plus opening future minus current spot into remaining months divided by total months. So I have to take this closing spot 94.10. 94 point is different. .10. This is 94.90. Sorry. Okay. 93.96. You can also calculate in this way. So what I have done, if you can see the screen, I have solved in interest way. Like closing spot is 5.9, current spot is 5.1, and I have converted the future price into percentage price.
Into
But if you
percentages.
keep the future price in inverse, if you convert the closing spot as an inverse, if you convert the current spot as an inverse, you can calculate the closing future directly in an inverse form. Okay. So it's up to you. You want to solve the question in this way or in this way. But do solve in one way. Do not solve in both of the ways. Okay. Now close the contract by taking the opposite position. So first of all, you sell future. Now you will buy it. Sell future, buy future. Sell future is 94.55. Buy future is 93.96. So you are selling at higher rate, you are buying at lower rate. So it's a gain. 0.59 gain. Okay, here you have agreed to borrow at 5.45, but market moves to 6.04. So you have a gain 0.059%. Okay. So now you can convert this into absolute amount. 0.59 means 59 ticks. 59 ticks into tick value, as the contract size is 500,000. So tick value is 12.5 into number of contracts. So gain is 47,200. Now calculate the actual borrowing cost. That would be equal to amount of loan, that is 24 million. And you are borrowing for 4 months, divided by 12, into the actual rate of
Yes.
interest. Actual rate of interest is 5.9 plus 40 basis point. The actual base rate plus 40 basis point, 0.4%. 504,000. Gain is this. So net cost will be 456,000. Okay, 456,000. You can easily write the percentage as well. Now the cost is 5.9% plus 0.4, and the gain is 0.59%. So the total cost will be 5.71%. 5.71%. So that's the effective cost. 5.71%. So which one is better, forward or future? Forward is 5.77. This is 5.71%.
Future is better.
This is slightly better.
Sir, can I ask a question?
Yes, yes, please.
In the exams, are we obliged to put the amount in an absolute amount, or can we go directly with the rate of interest?
You
At the
can
last one.
look, at least calculate the gain amount in absolute and the final
Yeah.
amount. At least final amount and the gain amount. But to be honest, if you calculate the gain amount as absolute number and effective rate, or the final answer in an effective rate percentage, that would be okay, because ultimately you have to discuss based on the effective interest rate. So I will compare and discuss at 5.71. I will compare 5.71 with the 5.77%. But do calculate the gain, at least the gain in
Yes, the
absolute.
gain you can calculate, and then we take the closing rate plus the gain, and then we add up.
Yes,
So
yes.
we have to calculate the absolute amount for the gain only. The actual borrowings we keep it in
There is
percentage.
no such requirement to calculate the absolute amount, but it is always better to show the absolute amount, because in order to calculate the absolute amount of gain, you need to show that you have a knowledge of ticks. That's why
Okay.
I'm saying that.
Yes, the ticks is okay. Okay.
Good. Okay. There is another question, that if I only calculate effective interest rate cost, it will give me full marks. Effective interest cost in percentage. Okay, I have explained. I think I have explained that. Examiner has previously asked to calculate only with percentage. Just read question where examiner has asked to calculate in percentage, by the way.
No, this was in a previous attempt.
Okay. But do calculate the gain in absolute amount as well, because that will show that you have the knowledge of this tick structure. The formula is, I'm writing the formula here. Obviously, you do not need to write it in the exam. First of all, calculate the number of ticks. How you will calculate the number of ticks? Divide this gain with 0.01%. With 0.01%. Gain over 0.01%. Okay, then into tick value. Okay. How to calculate the tick value? Tick value is equal to contract size, that is 500,000, into 0.01% into 3 by 12. This is standard. Into 3 by 12. So that is 12.5. The number of ticks into 12.5 into number of contracts. No. Always deduct the gain from the borrowing cost, because borrowing is the interest cost. Gain is the income and cost is like outflow. So gain will be deducted, netted off from the cost. Next is, so let me calculate the investment side as well. Okay, let's quickly write the future. Sorry, forward. Okay, this is effective income. And how much it was given?
378 something.
378,750. 378,750. 5.05%. 5.05%. Okay. Okay. Now let's solve the let's solve the option, but let's copy all the steps of the future, because future and option steps are quite interrelated. So let me copy all the steps. Option. And this is investment. Investment is 18 million. Okay. And obviously it's an investment. That means you will receive interest. So it's a call option. And even it is also written here. Okay. Which contract we will choose? As we are going to invest in September, so only September is given. September contracts are given. September. September is given. Okay. Okay. What is the pricing given? 94.75 excise price. 94.75. So, 5.25. Okay. Number of contracts. 18 million divided by 500 into 4 by 3. No. Into 5 by 3. Because the investment of 5 months. Okay. So today date is 1st February. You are going to invest in at which date? 30th September or 1st September? So we are going to invest in 1st September up till 1st February. 1st September. So we will choose 30th September. No, today is 1st February. We are choosing 30th September. So how many months are there? Count. Feb, March, April, May, June, July, August, September. 8 months. Remaining months 1. Am I correct? Please check. Please check, everyone. Eight months. Okay, but the problem is, this is the excise price. This is not the September excise price. September contract exercise price. So this answer is not correct. This closing future answer. Rest is fine. Okay. Guys. So before doing this, let's calculate the premium as well. Premium cost. So what is the premium cost? 0.298. 0.298. Convert it into ticks. 0.298. 29.8 ticks. Because we have to divide with 0.01%. Into tick value 12.5. Into number of contracts 60. Okay, 0.298%. So now we need to calculate closing future, guys. This is very important, which I'm going to discuss. We need to calculate the closing future
That's where I
for,
had problems. That's
we
where I had
need to
problems.
calculate the closing future in order to compare with the option. And unfortunately, closing future is not given in this question. Today is 1st February. We will select the September content, but this statement. Just look at the screen. This 94.75 is the call price. This is the exercise price. So we need the closing future on 1st September, but that is not given. Okay, that is not given. Today is 1st Feb, that is given. You will choose 30th September, that is also given. Total months are 8. 1 month is remaining, that is also given. But the problem is, we need to calculate the closing future. That is not written here. So can anyone tell? Because if we don't get the closing future, we can't solve the question. So, sir, let's take the above closing future. You can't take the above closing future. That was the June contract. Okay, you can't take this closing future is 93.6. That is for the June contract. So can anyone guide that? What should we do now? We are unable to calculate the closing future. How to solve it? Anyone? Okay, just read the question carefully. It is given. It is given. Look at the data, guys. It is given. September future rate is given 94.50. September future rate is given 94.50. Okay. So September future rate is 94.50. That is 5.5%. And we are expecting what would be the closing spot. Now we are expecting that after the election, closing spot will be 4.5%. 4.5%. Closing spot 4.5. 4.5 means 95.5. Okay. Now calculate the closing future. What is the closing spot? 95.5 plus bracket start opening future 94.5 minus current spot 94.9 into remaining months divided by total months 95.45. Or in this way, what is the closing spot? 4.5 plus bracket start. What is the opening future? 5.5 minus the current spot 5.1 into remaining months divided by total months 4.55. Okay, 4.55. Now, instead of sell future, you will write call option. And then you will compare it. Call option exercise price. Exercise price. Exercise price that you will receive how much? 5.25. But the market moves to 4.55. You have entered into agreement that you will get 94.75, but market moves to 95.45. Okay. Please tell me, is it a gain or loss? Will you excise it or not? It's a gain or loss. Call means you will buy. This is not buy, this is sell. Sorry. Second one is sell. Simply write closing future. Otherwise, it is a sell. So why you are writing sell? Because this is the call option exercise price. Call means buy. Call means buy. So the other second position will be closing future. So you have entered into agreement that you will receive 5.25, or you have entered into agreement that you will buy, you will receive for 94.75. And now you will sell at 95.45. It's a gain. How much there's a gain? 0.7. How much there is a gain? Guys, everyone listening? Everyone is listening? Okay. Now this is how much? This is 70 ticks. 70 ticks into tick value 12.5 into number of contract, that is 60. 52,500. 52,500. Now actual investment income. So now interest rate moves to 4.5%. Now interest rate moves to 4.5% minus 30 basis point. Minus 30 basis point. 4.5% minus 30 basis point. And gain, now gain will be added. Now gain will be added. Or you can completely solve it. 18 million into 4.2% into 5 by 12. Okay. Gain is 52,500. Total is, it's up to you. You want to solve it completely or not. 367,500. Okay. There is one thing is missing, premium. Yes. One thing is missing, that is premium. Premium is okay. Income plus gain minus premium. .6%. 4.6%. So which one is better? Is this better or forward is better? Which one is better?
So 0.6. We are receiving.
Forward is better, na? Comparatively forward is better.
Mm.
But obviously we have to discuss this case. So let's do the discussion. So let's make one paragraph on the loan and one paragraph on the investment. Okay, forward rate is 5.77 in case of loan and future rate was 5.71. So which one is better, guys, for the loan case? $5.71. So let me discuss. This is loan case. And first option, forward effective rate is 5.77%, which is slightly above than 5.71% of future contracts. Future contract is better. However, although it is assumed that there is no basis risk or margin requirements here, but practically Aber company may face basis risk so the hedge may not be effective. What is basis risk? That spot will not move according to the plan and will not become equal to the future rate. And company may have to face the margin requirements. Although forward is slightly higher cost, but it is simple to manage as there is no margin and basis risk. Forward has higher default risk, but that can be managed if Aber company does contract with high credit worthy counterpart. Okay, do read its answer from the standard answer as well, but I explained it generally. It's credit worthy. Okay, that was the loan case. Then you will write from the investment case perspective. Okay, so investment case depends. If Aber company is certain about the election results, which is not the case here, company can go for forward contract as it will yield 5.05% return. However, Aber is not certain about the election result. So if opposition party unable to win the election, interest rate can go up. So in that case, forward contract will not be lucrative. In volatile environment, option is the best suggested case. You can write then that if opposition party wins and trust rates comes down, you will exercise the option. At least you will get 4.6%. But if opposition party unable to win the election, what will happen? Interest rate will go up. You will leave the option. You will lapse the option. You can enjoy the higher market rates. Okay. That's how you will compare it. Right? Any question? It is okay, guys? Got it? Any question? Okay. Got it. Okay, perfect. So I'm discussing the B part. Stay with me. In B part, you will give the heading that part B. And then you will give the three headings: Director A, Director B, and Director C. Okay, there was three directors, right? And the requirement was discuss the queries raised by each directors. Okay, what was the query of first director? Now listen carefully, and first of all we will discuss, then I will tell you the actual answer. Director A stated that Aber company should not be using derivatives, as trading in derivatives was not the part of the company normal activities. Therefore, shareholder would not expect the company to use the derivatives. Okay, just tell me from the Director A perspective. Is he right? Is he right? Director A. Only tell me from the Director A perspective. वो कह रहा है, guys, what Director A is saying, that Director A is saying that why you are dealing with derivatives. This is not your job. For example, you are in textile, you are cement, you are doing the other business. What was the business he is in? Distribution. Distributing the products. So please tell me, if you are in a distribution business, for example, you are selling the distribution, you are doing distribution, or you have the distribution of like toffees, candies, chocolates, ACs, fridge, cars. So your primary role is not do the derivatives. So is Director A is right? Is Director A right? No. So what should we do? Guys, Director A is not right. Let me explain. Director A has stated that Aber should not deals in derivative, as this is not primary business of Aber. Okay, that means we should not do the hedging. That means Aber should not do anything. No, that is wrong. This is not the case here, as Aber is doing all transactions. All transactions as hedging, which ultimately reduce the risk faced by shareholders. So technically, we are dealing with the hedging case. Shareholders will not question on using the derivatives to hedge the risk. It is a normal assumption that management will do hedging to protect company in uncertain environment. Okay, as country is approaching towards election, so there is highly uncertain circumstances. So it is in favor of company to hedge this risk. You know, when you are approaching towards election, everything can happen. Everything. You know, we as our country was going to election, everybody was expecting that other party will win. But even in the worst case, in the worst circumstances, certain other parties win the election. So everybody is now confused that who has won the election. In last election in US, people were thinking that Trump will win. Trump party will win. But surprisingly, the result was different. So Director A, you will not agree with the Director A statement. Okay. Then you will write the Director B. Okay, what Director B was saying, just read it. Director B understood that future or forward rate agreement might be the best solution if the central bank base rate rose up to 5.9 or fell down 4.5. So Director B is saying that future and forward are the best solution. However, she queried what would happen if rates did not rise as high as 5.9 nor fall as low as 4.5, Aber company could possibly lose the chance of benefiting from more favorable rates than those offered by the future and forward. So what should be the best answer? So you will explain that if company enters into forward or future contract, for example, in the loan agreement, if we enter into forward or future contract, and if interest rate moves more than 5.9%, our position is locked at 5.71. We will not pay more than 5.7. But if interest rate falls, we have to pay the higher interest cost. So similarly, if interest rate in investment case, if interest rate increases, we will receive only 4.05. But if interest rate falls, we will still remain 4.05. In forward and future, your position will be locked. If rate rises or even if rate falls, we have to pay or receive the same agreed rate. We cannot enjoy the market movement. Okay. So technically, he was asking about that go for future and forward. But tell me, if interest rate rises more or falls more, what will happen? You will simply explain that you will only pay the agreed interest cost if interest rate rises. You have to pay the agreed interest cost if even interest rate falls. Okay. Similarly, you will explain for the investment perspective. Okay. Okay. Right. Director B explanation is easy. Director C stated that option should not be used to hedge the 18 million investment as they would never be the best choice because of the premium. The best choice would be not to hedge at all. Do you think so? Okay, you will explain that option would not be favorable if interest rate rises. Okay, well, sorry. If interest rate falls, option would not be a favorable choice. But as we are approaching towards election, as there is a high uncertainty in the market, there's a high volatility in the market. What if opposition party wins? Interest rate would be down. We will be losing in the option. But what if the opposition party fails to win the election? Government can raise further interest rate. In that case, if we have entered into option contract, we will leave the option, lapse the option, enjoy the market rate. Okay. So you can explain that option, like in option, you will have to face the premium cost. So it may not be the best choice on paper, but it can be the best decision to do the option if there's a high volatility. Like this statement is true. That option would never be the best choice because of premium. Apparently, whenever you compare, we have solved so many questions. Option answer is always the worst. Remember, director C is right. But the problem is, here in this case, if opposition party wins, in that case, interest rate will go down. Otherwise, interest rate can go up. So option give us the leverage, the benefit that we can enjoy the market movement. Okay. Got it, guys? Any question? We are about to end the class. Or the director C narrative, or which one? Okay, director A. Anyway, we will solve mock question tomorrow now. We'll solve tomorrow. Okay, mock standard answer publish नहीं होता. मैं देखा नहीं है mock का question अभी. I will see and then I will tell that what about the mock answer. कोई नहीं, आंसर नहीं भी है तो क्या हो, we can discuss ना. At least we can solve it, we can discuss. Based on our experience, we can discuss. It's okay, we can discuss, don't worry. Okay, guys, do attempt a mock rest question. We will discuss it tomorrow. Thank you so much for joining. And if we get time, we will also discuss the swap part tomorrow. Okay, second question भी करना है. हाँ, we will solve it. We will solve. वो बाद में करेंगे.